Assalamu alaikum. Welcome to video 32 IFRS 11 joint arrangement. This standard and the next standard IFRS 12 are not in FR syllabus but is there in SBR syllabus. So, a joint arrangement is a contract where two or more parties undertake an activity that is subject to joint control. So the meaning is it could be two or more than two. They are jointly controlling it. IFRS 11 says that joint arrangement can take one of the two forms. So IFRS 11, when you're applying, the main thing that you have to see is which of the two forms that you are taking, because the measurement then differs. Whether it's a joint operation or whether it's a joint venture. Joint operation means parties that have a joint control. Okay, they have right to the assets and the obligation for the liabilities. Normally, they are not a separate entity to conduct joint operation. Joint venture, they also have the joint control, but they have the right to the net asset, and they are normally established in a form of a separate entity. So in joint operation, entity is not separate, but in joint venture, there's a separate entity that is created. Another difference is joint operation have right to assets and liability. Joint ventures have rights to net assets. Now, IFRS 11 requires, if it's a joint operation, you have to recognize the share of asset, liability, revenue, expense. And if it's a joint venture, you have to use equity method to account for it. Equity method I've covered under IS 28. So if it's a joint venture, you will follow IS 28 that we use for valuing associate, because associates and joint ventures both use equity method. But if it's a joint operation, then you will use the rule of IFRS 11. You will just take the share of your asset, liability, revenue, expense. That's it. So thank you for watching, and I shall see you in the next standard, again a very short standard, which is IFRS 12. Thank you.